What is wealth? Throughout the series we'll be running a brief segment on what is wealth. It compares Fred and John's financial affairs to help us see if we can determine what an accurate definition of wealth might be. I think you might be surprised. Fred bought the Ford station wagon new in 2002. He used a personal loan. His accountant liked the formula, as Fred could both depreciate the car at 25% per year and claim all the interest costs associated with the loan. The loan was fully settled in 2007, but when it was in place, the monthly payment of $730 per month, based on an 8% interest rate, was more than affordable. Fred kept his old Mazda until 2007 before selling it to his nephew. This allowed him to fully claim all the expenses associated with the purchase and maintenance of the Ford. The Ford is now worth $8,000. Fred knows that the car is not well structured for tax. The Ford is his only car, so after making allowance for personal use, he can now only claim 70% for business use. Still, 70% of all the running and maintenance costs isn't so bad. Fred really looks after his possessions. Even though he plans to sell it to his nephew, he still wants to use the best part for himself. John looks after his car too. After owning an old Porsche, which cost more than the third world debt to maintain, John decided he would always have cars maintained by the manufacturer. He achieves this outcome by selling them as soon as the warranty expires. This makes him very popular with his local Porsche dealership, because the Porsche warranty is only for 2 years. John traded his last car this year for a new Porsche, which cost $350,000. John seldom hassles over price, but like any true merchant banker, he's keen to see the deal structured properly. He negotiated a lease of 6% and a guaranteed buyback price of $225,000 after 2 years. John has no equity in his car. He views this as the price he has to pay to be an automotive fashion statement. John continues to hope that the luxury car tax will be repealed, but successive governments seem to like the tax more than the previous one. The luxury car tax means that only $1,080 of the special lease payment of $6,666 per month that John negotiated with a Porsche dealer is deductible. Welcome back. Today we're being helped in the reverse interview by Norman Ho. Norman, thank you for dropping in and helping us.
Welcome, Kerry.
Okay, Norman, you've seen what we've done. What's the most obvious question for you?
Well, with estate planning, we were talking about wills before. Do you think everybody needs a will?
Let's say everyone needs estate planning, but not everyone needs a will. I've had clients who haven't had a will yet. Their estate has been distributed exactly the way they wanted it because everything was in joint ownership. There was a husband and wife, nice simple estate, couple of kids, but something happened to the husband and the house was in joint names, so it automatically became his wife's. Their bank accounts were in joint names, so that automatically became his wife's. The car can easily be transferred through Vic Roads. So really, in their instance, there wasn't any need for an estate plan.
How do you know if you need an estate planner, Kerry?
I guess that you seek advice of somebody who's professional in the area. But look, if your affairs are in any way non-simple, right? That's a new term for complex. You need to be more aware of the fact that it might be necessary. What I'm saying is, if you have one wife only, children, property in joint names, bank account in joint names as the example we've used, you're less likely to need a will or an estate plan. But if you've on a second marriage, if there's children from previous marriages, if life is in any way complex, I'd be inclined to say an estate plan is absolutely necessary. But in any event, seek advice. Financial advisors are able to give advice in this area mostly, but check before you make an appointment with them. But also the specialists.
Can you have a power of attorney but not have a will?
Yes, you can. They're two separate things. A power of attorney, you authorise somebody to act on your behalf. Okay. And as we covered earlier, if it's a general power, you actually have to have legal capacity to act. So if you were in a coma or you were deemed incapable legally, a general power couldn't be used to handle your affairs, but an enduring power of attorney could.
Kerry, tell me about business issues that might occur in these situations.
Businesses are very complex, and I don't want to deal with businesses per se, but I'm happy to deal with business owners in this context. So I've had a situation where a client built wills at great expense, and then he came in and told me about his wills, and we actually analysed his affairs, and he actually owned probably a filing cabinet. Even though he had great wealth, the business was in a proprietary structure, which was traded through a family trust, which means he doesn't own it. He had an investment trust for investment properties, which means, again, it's handled by the trustees. So it's when you get complex affairs, like in business, it's very important to actually understand the ownership structures, because if you wanted to pass on something owned by a trust, you have to deal with that through the trust deed, not by a will. He had great superannuation accounts, but again, superannuation in this case wasn't distributed by the will because he'd nominated a beneficiary. So again, if you're having a will, you need to go back and look at all these things. So have I nominated a beneficiary for the super fund? If you have, the beneficiary will be honoured irrespective of what it says in the will. If you haven't, you should nominate the will as a beneficiary, and then we distribute it through the will. So yeah, it's a good question. Comes back really to an issue of complexity, I suspect.
And again, involving the other professionals involved, like accountants and solicitors that the client might have.
Exactly. So if you're seeking advice from professionals, the most important thing in my view is to actually have them talk to each other. When I was operating a financial planning business, that I found was the hardest thing to do. But when I was successful in getting accountants, lawyers, financial advisors and any other advice professional involved in the same room, the outcomes were always far superior.
And that always stems from the client, I guess, that they recommend their current professionals to the financial planner and have that liaison.
Yeah, I often find that the financial planner is actually the facilitator of those meetings.
Okay.
Yeah. I think the financial planner generally is more concerned with the overall, the holistic approach to creating somebody's wealth. And they're more likely to call in the other professionals, I think, than the other professionals.
Okay.
Look, Norman, I think we've run out of time for this reverse interview. You've been a superb reverse interviewer.
Thank you, Kerry.
Thank you very much for doing that for us,
welcome.
and thank you. Okay, that's the end of this show on estate planning. Next week, we'll be looking at goals again. We've gone through Go Dare once, and we'll start again at goals. We will be having Keith Abrahams, who's given us the book as part of our weekly 100 Goals prize. If you haven't done your 100 goals yet, you're very naughty. Go and do it immediately. Keith, you'll find very interesting. I'll look forward to catching you all next week. Don't forget our competition. Please go to the website and sign up for our 100 Goal Challenge. Prizes are being generously awarded by AIA Australia, who are giving a free risk assessment away every week, and 2 iPads to be won throughout the series. And also Keith Abraham, who's donated his book about finding your passion. Go to the website wealthplan.tv. Thank you for joining us on WealthPlan TV. I hope you enjoyed the show. Next week, we'll be dealing with risk.